a very good afternoon. You're watching the newsroom on ET Now. I'm Mubina Kabasi. Quick look at what the markets are up to. And well, it's been quite a choppy day really on an intraday basis. We started off with roughly about 11,520, slipped then to 11,440, and now we've rebounded to 11,486. So quite a choppy day on the large street today, but yeah, gains of 0.4% is what we are witnessing. The Sensex is at 38,900, and it's Pharma all the way today. Cipla, DRL, Sun Pharma are all your top Nifty gainers for the day. But let's flag off then some more movers and shakers on our market Fatafat segment. It's IT all the way, which has been the cynosure of all eyes, not just in the last couple of days, but all of 2020. Many IT stocks are hitting lifetime highs. You have an Emphasis, you have a Persistent Systems, all of them doing very well, even on the mid-cap area. In fact, Emphasis, like I mentioned, is at a lifetime high. It's rising, in fact, for the 5th straight session in a row. The other stock we would like to flag off is PVR, but this one's on the downside. The numbers are obviously not good because, the theatre revenue is zero. And, the company has obviously, because of that, had posted a loss of almost 225 crore rupees versus a profit of 18 crores in the corresponding quarter. On the EBITDA front as well, the loss is 116 crore rupees. But, I guess PVR INoX will all be in focus because the multiplex operators have made a case for them to be opened in line with global practices. Of course, it's just still communication and talks that's on between these operators and the government. We still have to wait by for any sort of announcement from the government regarding them opening up. And Adani Green, another counter in focus. In fact, this is the first Adani company that has actually crossed, the 1 trillion rupee, the 1 trillion rupee mark. So this is definitely in focus. It's another day in a row where we have seen Adani Green really hit upper circuit, third day in fact, and it's become the first Adani Group company to cross 1 lakh crore rupees in terms of market capitalization. Another stock in news is JB Chemicals. We have the Q1 numbers that are still trickling in, and JB Chemicals has delivered its first quarter numbers as well. How exactly is it reacting and what were the numbers like? Well, let's first touch upon the numbers. Revenues came in a little higher at 522 crore rupees versus 443 crore rupees, and on the bottom line the company has delivered a profit of 120 crores versus 62 crore rupees. JB Chemicals today is surging 10% at 916 crore rupees. 916 rupees per share. But Tech Solutions, on the other hand, is plummeting. And how? This is in fact one of the few technology companies that's not really participating in this uptick, and I guess rightly so, because the revenues have tanked. And how? From 583 crores in the corresponding quarter to just 166 crores, and the company has delivered a massive loss of 500 crores in just Q1 versus a profit of 160 crores in the corresponding quarter. So Tech Solutions today is among the top losers in trade. Okay, well, in an exclusive conversation with ET Now, we spoke to Prashant Kumar of Yes Bank, who anticipates strong deposit growth in FY21. He also says that he's seeing green shoots in the retail segment and the MSME segment. Here's a slice of that conversation.
And the similar trend we are seeing in the current quarter also. And I think we would be having a very good growth in the deposit during the current quarter, and I think the testimony is like we have been able to repay 50,000 crore to RBI, and we are focusing on retail, but definitely the corporate side, it comes as a large amount. So on the retail side, it will take some time to match the contribution coming from the corporate. But if we see in terms of number of new customers which we are able to add on the retail side, so I think we are seeing an unprecedented thing that even during the current COVID times, now we are able to open almost 60,000 accounts every month. And before like COVID and before the bank was put under moratorium, our peak rate was something around 55,000. So we are targeting to say add at least 1 lakh retail customers every month to the bank. So our focus would be more on the granular and the retail deposit.
Got a massively stressed BB book. Could you tell us what are the major laggards here and any notable recoveries on the anvil that might materialize soon?
We were expecting some recoveries out of this portfolio. We are on track. But I think it would take a little longer time because of the current COVID situation. But I think at the quarter end, we would be able to share those numbers in terms of recovery. But it's a very large portfolio. And I think we are firing all engines to get our recoveries on track. Only thing is it takes little longer time. But I think things are progressing very well. And we would be able to achieve our targets by year end.
Okay, well, of course, the big news has come in from SEBI for multi-cap fund owners. There is going to be a little rejig in the composition of your multi-cap fund. So what should you do next? And, how will this composition essentially affect your returns, the risk profile as well of a multi-cap fund? We spoke to Kaustubh Belapurkar, the Director of Fund Research with Morningstar Investment Advisor. Here out his advice.
The manager wants to kind of maintain the strategy that he's been running for a while, then the option really for them is to exit the multi-cap strategy, and they would either move the fund into a category which is closest aligned to how they've been managing the strategy in the past. But remember that SEBI also has a guideline that for most categories you're allowed only one fund per category. So if they already have a fund in that category which they think is the best fit, then they would eventually need to merge the two strategies into one single fund as per SEBI's guidelines. The other option, obviously, is for them is to actually go and meet the guidelines as per SEBI's put down, which is 25, 25, 25 in large, mid, and small. So that's a decision I think. Obviously, managers are right now in consultation with the various stakeholders, considering what their investment mandate has been in the past and what is probably in the best interest of investors. Is what they're going to kind of, try to get at, which is the best possible solution in the change in the amendment of the guidelines and the regulation.
Let's say for individuals who, are going to see their multi-cap funds, Kaustubh, adhere to the SEBI norms, which means they'll have to buy more small caps into the fund, they'll have to buy more mid caps into the fund, and perhaps sell off some of the large cap stocks. Because like you mentioned, a majority of the multi-cap funds do have 60 or 65% upwards in large caps. So do you think there could be some fluctuation in returns from the multi-cap fund that, these unit holders can expect, in the course of the next 4-5 months until Jan 2021, which is when SEBI has said that these funds have to adhere to these rules?
Sure. So, I think, Mubina, the most important thing to understand is that, and the most important thing that, when we speak to the fund managers, is try to do as little disruption as possible in terms of the investor experience of, kind of maintaining a status quo on the strategy. So, like I said, I probably expect a lot of them to reevaluate which category that fund would fall into. But if there are strategies that will potentially say, okay, look, I want to get into this category of stay in the category of multi-cap with a 25 minimum in each of these. I think from an investor's perspective, there are two things to understand and acknowledge. One is that this fund, you have to kind of evaluate, is that continuing, is it useful to be a part of your portfolio or not, given the new mandate under which it will apply? Because if you've traditionally invested in a fund that has maybe a 70-30 or a 80-20 large cap sort of holding, and depending on your risk return objectives, and you need to understand that the fund is not the portfolio itself, it is a part of the portfolio. So you need to look at it holistically in terms of what is the overall allocation of your portfolio amongst the other funds that you hold. So I think these are things that investors will need to keep in mind. But obviously, the bottom line is that if a fund that's been traditionally managed with a large cap bias does move 50% into small and mid caps, the risk profile of that fund does change. But like I said, you need to look at the intermingling of that fund in your portfolio rather than just the fund as a standalone, and then take a holistic call. That said, I think, obviously the asset managers are in consultation with the regulator, and they will figure out the best course of action, which they believe is in the right interest of their set of investors. So, I would just wait for this space before really jumping to a conclusion. And that's the advice that I would give to investors, that do not take a hasty call. Do not try to think that, if the fund's going to get into small and mid caps, potentially smaller and mid caps can run up. I wouldn't really get into that. Stick to basics, stick to asset allocation, wait for your asset manager to communicate in terms of the guidelines what they plan to do with the strategy.
Welcome back. You're watching the newsroom on ET. Now, important news on the bottom of your screens. The parliamentary panel has suggested abolition of the tax that's imposed on long-term capital gains if a network has invested in startups. This they are proposing be done away with for 2 years to encourage investments. Additionally, they are saying that this is also being primarily done to encourage domestic capital to be sort of flowed in or invested in startups, because the current tax disparity is proving beneficial to foreign capital because of the whole low tax jurisdiction bit. So what essentially the parliamentary panel aims to do is encourage domestic money to flow into unlisted debt and equity securities via this 2-year abolition of tax on long-term capital gains. We have with us Saurabh Srivastava, the founder of the Indian Angel Network. He's joining us now on the show. Dr. Saurabh, thank you. Let's get in your preliminary reading of this news. Abolition of LTCG tax in startups, but for a period of 2 years. What do you think of this news? I mean, is it something that would sort of give domestic capital as well a level playing field with foreign capital?
Well, I think, firstly, I'm delighted to hear that the Parliament is looking at it, or the committee has proposed it, because this is something that the startup community has wanted for a long time. As you know, today you get a very preferential treatment on taxes if you were to invest on the stock exchange. However, investing in a startup is inherently more risky. Very few people do it. And it is long-term capital because it's capital that grows to create new ventures, new jobs, new products. So it's very beneficial for the country, and we have seen during these COVID times how startups have jumped into the fray, taken the challenge, and really pretty much reduced everything that we used to import as far as requirements, whether it's ventilators or anything else. So what this will do is it will encourage domestic capital to put money in startups. The last few months, 5 months, have been very bad for startups. Venture capital money has dried up. Startups are facing a tough time, staying alive. This will give it the fillip that they want. Is very deserved. It will help employment. It will help creation of innovative products that meet our needs. It will help the whole idea of Atmanirbhar, which the Prime Minister wants. And we lose nothing because this capital will create enough wealth which will give the taxes that the government may have notionally lost in this area.
Dr. Saurabh, I think the other key the parliamentary panel has also suggested is that it will be done away for 2 years. Do you think that putting a time limit like this would perhaps spur exits, by investors, VCs, angel investors over the course of the 2 years?
No, I don't think they would have meant exits.
If such, go ahead.
I don't think they would have meant exits. So I don't know if they would have meant exits. I think what they would mean is for investments made in the next 2 years. Because if it's on exits, then it doesn't encourage investment because it relates to investments already made. You can't exit something, invest this year and exit this year. So I think I have not seen the proposal. I imagine it would be for investments that are made in the next 2 years. Because the exits in the next year or two would relate to investments that have already been made. So that doesn't encourage any investments to be made now.
Exactly. Yeah. I just wanted to get in that clarification because an LTCG obviously is earned when you realize the gains that you've made in an investment in a particular startup. We also have with us Siddharth Pai. Saurabh, request you to stay on with us. Siddharth Pai is the founding partner of 314 Capital. Siddharth, thanks so much for joining in. Let's also get in your initial take on this news. Abolishing any sort of LTCG tax. Do you think that is something that would spur domestic capital to flow into startups?
It will, definitely, because I think, the reason why we have such emaciated participation from rupee capital in the Indian startup ecosystem is actually primarily driving down to the reason of tax. In terms of your gains from startups, you actually pay 2.5 times the tax that you would if you had actually invested into a listed market itself. And as a fund manager, they've actually been, and all fund managers in India will actually tell you, fundraising and selling the India story in India is actually the hardest, and income tax is actually one of the primary reasons for the same, because the after-tax decision to invest actually veers a number of Indian investors to the stock market as opposed to new asset creation in the form of startups. So this has been a long-standing ask of the entire startup ecosystem as a whole, and I do hope that the parliamentary panel's recommendations on this get taken into consideration very seriously by the finance minister as well, so that we can actually have higher rupee capital participation coming in, which will actually result in greater economic growth as well as an increase in the number of jobs for the entire Indian economy.
I would have actually loved to squeeze in a question also on sort of the tax arbitrage that exists between foreign capital and domestic capital, but my producer tells me we're out of time. So, gentlemen, Dr. Saurabh as well as Siddharth, thank you so much for joining in. This is still just a parliamentary panel recommendation. We still have to see it come on paper, but we'll wait for that. Definitely good news for the investor as well as for the startup ecosystem, because it would spur more investments, particularly domestic capital, to flow in. And not to mention, of course, like Dr. Saurabh said, the whole Atmanirbhar move as well that the Prime Minister and the government is promoting. Okay, on that note, we're completely out of time, so we'll wrap it up.